Hello, friends. Today we're taking a look at the Hershey Company, ticker symbol HSY. Hershey's has been down almost 30% in the last 6 to 7 months since April, and it is getting very close to their 52-week low of $184. So the question that I would like to answer today is Hershey's a good buy now? Normally in the past it has been very expensive to buy, but with a PE ratio right now of 20%, maybe this is a time for us to consider whether we should be adding this stock to our portfolio. In the last month, it has lost 2%. Year to date has lost 20%, almost 20%, but like I mentioned, almost 30 something percent from their May highs. And in the last 5 years, it has gone up 71%. So that is a pretty good return. And before that, it was going very, very fast. So they pay a dividend of $4.77, and that is somewhere around 2.57% at current prices. The analysts are expecting the price to go back somewhere close to the February prices, which would be around almost 27%. They're expecting to recover to those prices in the next 12 months. And the question is this going to happen? What is it that is happening to Hershey's that has created this big drop? And we'll be taking a look at that. Before that, so that we understand what Hershey's does, they make mostly chocolate and snacks. A lot of very famous one like Almond Joy, Cadbury, Heath, of course Hershey's and Hershey's Kisses, Kit Kat, Milk Duds, Payday, Reese's, sorry, Whoopers, York. They also have the bubble jam, Jolly Ranchers, Ice Breakers, Twizzlers. They also have the Skinny Pop. I eat a lot of that, trying to lose weight. And then the One brands, among other ones. Hershey's reported earnings on October 26, and they beat in earnings and beat in revenue, which is good. However, analysts are still thinking they're negative on this company, and they believe that it's going to continue to go down for a couple of reasons. So in the last 90 days, there has been one revision up and 14 down. So what are some of the reasons? One is, of course, if you have been paying attention to the news of stocks, the big two things that analysts have been focusing on is AI, which has nothing to do with Hershey's, but also weight loss. How a lot of analysts are thinking that people are trying to move into more healthy habits. They're trying to lose weight. There is quite demand of drugs for losing weight. So this has been affecting a lot of these candy, sugary companies like Pepsi, Coca-Cola, and of course Hershey's. Now Hershey's, Coca-Cola and Pepsi has not been hit that bad. If you would like to get a little bit more information or an analysis on Coca-Cola and Pepsi, I made 2 videos on that. I'll put them up in the description so that you can check them out. But the main issue that Hershey's has been having is the cocoa prices. Cocoa prices since April, which will be somewhere around here, they were at 3,000 per ton. Now they're close to 4,400. So if we were to take the the price, and we subtract that, divided by by this, it has grown at 46% in the last 6 months, uh, 6, 7 months. That is, it has not hit Hershey's yet on the bottom lines. They have some pricing power because um, of the brands that they have, but analysts are thinking that it's going to eventually have to give, because you cannot be bringing up prices 40 to 20 to 40% in order to make those margins. So that is part of the reason why there has been a big sell-off as prices continue to go up, especially in the cocoa industry. So let's jump into financials. But before we jump into it, I would just like to invite you to subscribe. Leave a comment. Let me know what you think. If there's any other things that we should be considering about this this company, this stock, if we were to buy it. Please subscribe, leave a like and a comment, whether you have it, whether you like it or not. This stock, let me know in the comments down below. So, in the last 10 years, Hershey's has been growing at about 5.5%, but in the last 5 years at 8%. And this is believed to be because of kind of the COVID uh, effect. A lot of us stayed home. We ate a lot. We got to eat a lot of snacks, and then we just kind of kept those habits afterwards. At least here in the United States, we saved a lot of money by not going places. So a lot of people have kept their spending, even though in this past year it has been starting to hit the wallets of a lot of families. When it comes to earnings, you can see a very nice growth since 2017. A growth of close to 10%. Profit margins are about close to 16% in average in the past 5 years. I do like these numbers. 10% of growth in earnings, that's minimal for me to consider. Now, when it comes to free cash flow, these numbers are pretty low. They have been growing free cash flow in the last 10 years about at 7.5%. And in the last 5 years, almost 5%. And I would like these numbers to be bigger if I were to want to consider this company to grow, to buy. The average free cash flow margins is at 17%. The book value has been growing in the last 10 years for about 10%, and in the last 5 years of 24%. Those are good numbers. The return on invested capital numbers are 22%, which is great. On return on assets is 15%, which is 3 times what I normally look for, so great. Return on equity is at 66%. Those are the average in the last 5 years. Those are amazing numbers. I would like to look more into their quarterly reports and annual reports to see what is going on with their free cash flow. Why are their free cash flow numbers lower than their earnings? So that will be something that I will be paying attention to. When it comes to dividend, they have been growing their dividend. Their payout ratio is close to 50%, which is okay. And they have been growing their dividend close to 9%, which is pretty nice. The long-term debt can be paid in less than 3 years with their average 5-year free cash flow. Their shares, they have been buying shares back slowly at less than 1% in the last 5 years. And when we look at their estimated growth by the analysts, they believe that the company will continue to grow at about 8% a year for the next 5 years, yearly. So whenever we put all the numbers together, revenue growing at 8% in the past 5 years, 10% in earnings, free cash flow close to 5. We're looking at an average of 11%. Before we jump into the multiple valuation, I just want to remind you that I am just a YouTuber. I'm not your financial advisor. So anything that I say here is for educational purposes. This is not a recommendation to buy, to sell, or to hold. This is just my opinion, and I would love to hear your opinion. Once again, just make sure to subscribe and leave the comment down in the comment section. When it comes to multiple valuation, we take the average 5-year revenue per share, earning per share, free cash flow per share, book value, and dividend, and we look at the median of the last 10 years of what the market has been wanting to pay, what multiples have been giving to Hershey's. And as you can see, some of these earnings and free cash flow numbers are higher than normally. The average is somewhere between 18 to 20%, 20 PE. So with those numbers, we're looking at a fair value estimate of somewhere between $175 and $230 that the market has been willing to pay. Whenever we look at the payback time, I will be using at 5% because that's about what the free cash flow has been growing in the last 5 years. If we expect that to continue, we will be looking at a payback time, collecting all the free cash flows for the next 15 years of somewhere between $172 to $188. If we wanted to then look at the earnings and growing at a 9%, which is a little lower of what they have been growing in the last 5 years, we will be looking at growing them and then discounting them back for the past 5 years. That will be somewhere between $142 to $200 fair price. If we look at the owner's earnings valuation, we'll be looking somewhere between $129 to $148. When we put all the numbers together, we will be looking at an average entry fair price of $186. And right now is setting at that price. So that will be the fair value. If we wanted to have a 30% margin of safety, that would put us about $130 as an entry price, and that will put us back to way before. It will be somewhere in the 2019s. If we just think that it has a strong moat and we were willing to pay a little bit more for it, that will be at 20%, and we'll put a price at 150, which will put you 145, 150 will put us before COVID prices. So this is my opinion. I'm probably going to be doing a little more research on their numbers and make a decision whether to buy or not. This will be a company that I will be looking at because of their moat, but I think that it's still a little overpriced. So I may be looking at jumping in if it got somewhere around $150. Once again, that's not a recommendation. Let me know what you think, and I hope to see you in the next video.